basis, Form 1065. And it can also elect to be treated as a corporation. And there are two subcategories there. It can elect to be treated as a regular corporation, a taxable corporation, a corporation that pays taxes on its income. We don't really see that very much, to tell you the truth, because it's almost defeating the purpose of forming the LLC for the small business person who's looking at simplifying his tax while keeping some of the benefits of a corporation. But what we sometimes see is an LLC is created and it elects to be treated as an S corporation. And an S corporation is a pass-through entity for tax purposes. It pays no tax, but it does file a separate tax return, and the net results of the operation of that entity, either a net income or a net loss, is reported on a Form K-1, which is given to the partner, and the partner then includes that net loss or income on as one line on their tax return.
I know that limited LLC is limited liability corporation, and a lot of people like that because for lawsuits or anything like that, they feel like they're a little bit more protected. Is that really true?
And in my practice, that's where we see you need to speak with your attorney, a knowledgeable attorney, a knowledgeable real estate attorney.
Right. Yeah. And that is the difference. And I, again, appreciate recognizing the difference there. I provide legal advice and the liabilities and the legal benefits of being a limited liability company versus being a corporation or a partnership. I can advise legally why you would want to go one way or the other, but the tax consequences I have found, for the most part, are as or more important, because an LLC, a limited liability company, or a corporation usually serves my client's interest of protecting them personally from liability. So they own the property in the LLC. If something were to happen, the only liability would extend to the LLC, and they could always close it down and it wouldn't affect their personal lives. But the tax consequences are a large part of the picture. That's why I refer to Tom Flavin. Yeah.
Very good.
And other things that come up in my practice are, we do deal with a lot of foreign investors as well. So we come across the Foreign Investors in Real Property Tax Act, or also known as FIRPTA, and we have clients, buyers who are buying from foreign sellers. Sometimes they're foreign sellers, but they're concerned both with their purchase, which usually isn't an issue, but I like to advise them, look, there's no problem with you buying this property now, but you need to be aware of FIRPTA for when you eventually go to sell. Any information you can impart regarding FIRPTA?
Well, yes.
Lots of things.
First, let me say that there are over 185 separate tax treaties that the United States has with other foreign entities. And so we can get into trouble if we start making too many blanket statements about foreign sellers of real or alien sellers of real estate here in the United States. However, in my practice, we see often we'll see our friends from Canada who may have a property here, either buying or selling a property, Great Britain, United Kingdom, France, Germany. Those are the countries that we most often see with foreign citizens involved in real estate transactions.
And the Space Coast.
On the Space Coast.
In the South Florida, it's mostly Central America.
That's correct. That's correct. But here in the Space
South
Coast,
America.
That's where we see most of our visitors who are involved in real estate transactions coming from. And now let's talk generalities. So as a foreign investor or foreign holder of real estate, when I go to sell my property, Uncle Sam, what's he afraid of? He's afraid that I'm going to get a big pile of money from the sale of my property, and I'm going to go back to where I came from, and I'm not going to pay any tax that might have been due on that. So consequently, we have FIRPA, which it requires withholding at source. And generally, that means that the closing title agent is required to withhold proceeds at the source of the transaction. Now, the key word there is withhold. It's a withholding amount it is not a determination of tax. It's an assumption that there's going to be some tax due, and therefore let's withhold some at the closing and remit it to the IRS, and then let the seller of the real estate worry about getting it back later. How does the seller get it back? Well, often they have to file a tax return, a 1040 NR, non-resident return, and show via the filing of that return that there was no gain on the property, or the gain on the property did not result in taxable income, and therefore they're entitled to a refund of the tax that was withheld. And so that's kind of an overview.
Okay, great. And there are methods by which you can get some certificate of non-liability or something, correct, so as the sellers can get their money back more quickly.
That's correct.
Now, if I understand it correctly, if the seller, even if they're foreign-born, if they have a Social Security number here in the United States because they had been working here or whatever, for whatever reason, or if they own it in a corporate entity that has a tax ID number, then would that avoid the withholding requirement?
Yes, many times it does. So if the foreign seller has, as you said, has a Social Security number or a tax identification number, which is different than a Social Security number, but it's another way for the IRS to track the existence of someone who's involved in a transaction, but is not necessarily a U.S. citizen. There are methods for obtaining that exemption from withholding in advance. The key here, of course, is planning. Don't call your title agent the day before the closing and say, can you get me to a CPA who can help me avoid the withholding? I don't want this withholding to take place. It's going to take allow maybe 6 weeks of advanced planning and filing in order for that certificate of exemption to turn around from the Treasury Department.
So for those of you listening, especially the realtors out there, we do have a real estate show, so we hope to have many real estate agents listening to learn all this great knowledge. And for those of you listening, when you are dealing with foreign investors, and again, we call them investors, it could be for their own residence, but if they're buying real estate in the United States, buying and then ultimately going to be selling, make sure they're aware that these issues are out there. It's not a big deal. You reach out to Mr. Flavin and he can help you out, but you don't wait, as you say, to the last minute and then have the crisis. You want to be the educated agent who educates your clients so that everything goes smoothly.
That's correct. The key is giving everyone enough advance time in order to deal with the challenges so that your closing goes smoothly.
The last thing that I can think of in the few minutes that we have left, time goes so fast on these shows, is 1099s. It hasn't been a big issue, unfortunately. Many of my clients, anyway, have not been profiting from the sale of the real estate over the last few years. In fact, have often had losses. So the 1099s have not been a significant issue. And of course, we have the exemption for the filing when it's under $250,000 for a single person and $500 for a married person. So again, we don't see it too often. But thankfully, the market's coming back in stronger, and we're going to start seeing more 1099s that may result in tax consequences from the sale of a home. So maybe you can give a little brief overview of adjusted basis and things that result in potential tax consequences.
Okay, well let's talk about basis, and let's define that term basis. What's my basis in my home? Well, initially it's what I paid for it. I sign the real estate contract, I go to closing, and the contract says $500,000. Okay, there's my home. I paid $500,000 for it. That's my basis. If I turned around 5 years later and sold that home and sold it for less than $1 million, assuming that I'm married, I'm not going to have any taxable gain. So I could sell it for $999,000, whatever. I could sell it for $990,000 and not have any taxable gain. Why? Because I'm as a married couple, I can exempt the first $500,000 of gain. As long as I can say I lived in the house as my homestead residence for 2 of the last 5 years. That qualifies me. Now, what can cause you to have a different basis or an adjusted basis? Well, let's say I bought the home and it had no swimming pool. And the first thing I did was I went out and put a $50,000 swimming pool, installed that swimming pool in my home. Now I have basis in my home of $550,000. I paid $500,000 for the home, and I installed a $50,000 swimming pool. Let's take another example. Let's say I looked at the paint on the outside of the house, and I said, this house needs a new paint job, and I spent $10,000 on painting it. That is not an increase to basis. Why? Because that's a normal repair. The IRS would look at that and say, all you're doing is maintaining the property, dealing with normal wear and tear. It's not a swimming pool. A swimming pool is you're installing a capital improvement that wasn't there before. Likewise, if I installed a new kitchen or substantially upgraded the bathrooms, if I did anything that involved knocking down a wall and relocating it, these are capital improvements. And these are items that are going to increase the basis in your home.
And at that point, you want to always keep your receipts.
That's right. So everyone calls my office and says, how long should I keep my receipts? It's 3 years, isn't it? And I say, it depends. 7 years if it has to do with your normal income and expenses. However, if it concerns real estate that you own, keep it as long as you own the real estate and then for another 7 years. so don't throw it away, don't destroy it, don't shred it, because that may be all you have to prove your adjusted basis in your property.
What about a roof? That seemed to me sort of a hybrid. If you need a new roof, is it maintenance or is that a capital improvement?
Okay, that can be a little gray. Normally, what's a roof? Well, it wears out, doesn't it? Mm-hmm. Depending on the type of material that you're using on your roof, maybe 15 years, maybe 20 years. If it's a solid slate or tile roof, maybe 40 years. Mm-hmm. So we'd like to think of it as a capital improvement. The truth is, you could end up getting pushback in an audit situation from the IRS, depending on the age of the roof. Again, now you have to prove, when did I have this roof installed? Maybe I paid $20,000 for it, but that was 15 years ago. What's the real basis of that roof now? What's the fair market value of the use of the roof that's left after 15 years? So you could get into some back and forth in an audit situation. However, what I recommend to clients is, if it's a major improvement, a roof, keep those records. If we need to use those to help minimize taxes, should you sell the home, we're going to do that. Mm-hmm.
I have a couple of things here on a can't deduct list. Home expenses you can't deduct. See if I'm correct on these. You can't deduct the years you've paid on homeowners insurance premiums.
That's correct.
Okay. Fire insurance premiums, FHA mortgage insurance premiums, principal payments made on your mortgage.
Yes, those are non-deductible.
Non-deductible. When we're talking about capital gains, and we only have a couple seconds left here, what about when you have to rebuild because of a hurricane? They've come through and you've got a high deductible, and now you've got to spend $10,000 out of your pocket to rebuild something or repair something. Would that be part of your?
Yes, there are all sorts of rules that come in play. You know, we live here on the Space Coast. Occasionally we have, it's paradise really, isn't it, folks?
Yes.
We live in paradise. But every now and then we have a hurricane that blows through and may cause some property damage. So the general rule is that non-reimbursed losses that have decreased the value of your property are going to be deductible to you as casualty losses. Now, there are limitations there. Normally, you can only deduct those to the extent that they exceed 10% of your adjusted gross income. But more often than not, when we have a bad hurricane, we're declared a presidential disaster area, and that changes the rules substantially.
There are so many things in the show, just flew by. Thomas Flavin, thank you for joining us today. Give out your information again, how somebody can contact you.
We're at 321-725-4700 at 2200 South Babcock in Melbourne, Florida.
Thank you so much for joining